Standard cost accounting methods used are consistent with GAAP. By using a standard cost for quantity and cost, it allows for calculations on the company's performance during that period to see how good or bad they did. It also enables managers to evaluate how different departments do separate of each other, for example, a production manager and a purchasing manager. Research has shown that a substantial portion of companies in the United Kingdom, Canada, Japan, and the United States are using the standard cost systems. This is because the standard cost system may offer advantages including things such as standards that are viewed as reasonable by employees can serve as benchmarks that promote economy and efficiency. Standard costs can greatly simplify the bookkeeping for a company, and standard costs can also fit naturally into a responsibility accounting system. The use of standard costs can also present a number of problems. For example, standard cost variance reports are usually prepared on a monthly basis and are often released days or weeks after the end of the month. This means that the information can be outdated. If the variances are misused as a club to negatively reinforce the employees, morale may suffer and employees may take a dysfunctional approach. Labor variances make two important assumptions. First, they assume that the production process is labor-paced. If labor works faster, output will go up. Second, the computations assume that labor is a variable cost. These assumptions are often invalid in today's automated manufacturing environment, where employees are essentially a fixed cost. In some cases, a favorable variance can be as bad or worse than an unfavorable variance. Excessive emphasis on meeting the standards may overshadow their important objectives such as maintaining and improving quality, on-time delivery, and customer satisfaction. Just meeting standards may not be sufficient. Continual improvement may be necessary to survive in a competitive market today. Actual cost accounting is also known as full cost accounting. It is a process of collecting and presenting information for each proposed alternative when a decision is necessary in a company. This method for cost accounting traces direct costs and allocates indirect costs.
ABC costing makes sense for companies that produce a lot of different products or services because it assigns costs to different activity cost pools in order to decipher which activities and products are most resource consuming. ABC costing allows these companies to see which products are beneficial and which need improvement by providing managers with information about each product's cost and profitability. Managers use this information to implement changes that result in increased efficiency, which is what all managers attempt to provide. Note that ABC costing is more expensive than traditional costing methods because it requires that information be constantly gathered.
The job order costing system is a fundamental tool of managerial accounting. Job order costing systems are used in companies that produce many different products. These companies want to find out how much the products they make are costing the company. The company will trace and allocate costs that occur during the job. They will divide that number by the amount of units produced to see how much the individual product cost per unit. For a typical job, direct labor and direct materials are tracked at their actual values. They are then recorded and tracked until the job has been completed. Once the costs have been recorded and the product is completed, the cost will transfer from work in process to the finished goods inventory. The job order costing system is not perfect for every business, but it is a very useful tool for others. Businesses such as a clothing company would use job order costing. It would be a very effective way to keep track of how much each different product is costing them to produce. When a company knows how much each unit is to produce, it makes setting a price for the product a lot easier.
Variable costing, sometimes referred to as direct or marginal costing, treats fixed manufacturing overhead as a period cost. Variable costing is less confusing than absorption costing because it doesn't artificially increase income by increasing production. Variable costing provides more realistic net operating incomes. It also produces a clear income statement that reflects what managers expect to see, resulting in less confusion compared to absorption costing.
Process costing is a type of costing system that is used for uniform or homogeneous products. Process costing averages the cost over all units to come to the per unit cost. This is different from other types of costing systems that are used for products that are in different batch levels. An example of where process costing could be applied is in sugar mills, where it is a continuous process and all of the products are the same.
German resource consumption uses fixed and proportional costs to show managers how to better allocate costs for optimal efficiency. This method looks directly at the operational resources and bases the costs and revenues off of them. The quantities of resources indicates how well the company will do. This form of accounting is useful for companies that mass produce products that are similar to one another, such as BIC, BIC, who makes pens, lighters, and similar products.
Like LIFO, first in, first out is a way of organizing and manipulation of data relative to time and prioritization. This expression describes the principle of a queue processing technique or servicing conflicting demands by ordering processes by first-come, first-served basis. What comes in first is handled first, what comes next waits until the first is finished, etc. Most used by small businesses, allowing the inventory to be continuously turned over. By definition, in a LIFO structured linear list, elements can be added or taken off from only one end, called the top. A LIFO structure can be illustrated with the example of a narrow, crowded elevator with a small door. When the elevator reaches its destination, the last people to get on have to be the first to get off. This process is used in the oil business to control prices. LIFO and FIFO are the same. Both mean the most recent entry is next to be processed and the oldest is last to be processed. Imagine a stack of cards built by placing one card on top of the next. Now imagine pulling the cards off the stack one at a time. The most recently placed card, last in, is the first to be removed, first out, and thus we have LIFO. Similarly, the first card that was placed in the building stack, first in, will be the last card, last out, to be picked back up when destacking the stack, and thus we have FIFO. Thus, LIFO and FIFO are the same.
Average costing uses the average of all units available for sale during a specific accounting period and uses that average cost to determine the value of ending inventory and cost of goods sold. Average cost is computed by dividing the total cost of goods available for sale by the total units available for sale.